Good day, fellow investors. One of the key questions when it comes to value investing is how much cash to keep for opportunities and when. And there was this great discussion on inflation eating your cash, that is for sure, but also taking advantage of opportunities when those come. And Buffett now has a lot of cash that we will discuss. The four topics I want to discuss today is inflation, eating away your cash position. Then it also depends on the opportunities out there. Warren Buffett predicting a crash, the opportunities now we have to discuss, and then there is also just a quick fact, moment in time versus dynamic overview. Let's start immediately with inflation is definitely and surely eating your purchasing power. If we look at the inflation chart, we are now a little bit lower, 2.5, 3.3 average for the year, but we have seen peaks of 9%, and for 2 years inflation was significantly impairing your purchasing power. Given the debt levels out there, the money printing, the lowering interest rates, it is likely that this period of low inflation is over forever and we'll see ups and downs in the future. Very possible. We have to be ready for that. Plus, if you just buy treasuries, then the real return currently is 0.54%. So you are not getting anywhere, you're just protecting your money with the 10-year treasury or 1% real return with the shorter term. But even Warren Buffett is selling half of his Apple, and we'll see if he sold more in this quarter. Cash pile climbs to record of 277 billion and net stock sales reach 75 billion. So slow repurchases, still making money on earnings, but really increasing that cash pile to 25% of assets. And now you see this jump in cash to assets, you compare it to 2005. Of course, what happened then was this. Can we predict a crash? Is Warren Buffett again predicting a crash? Well, that's difficult to predict because we could say that stocks were overvalued even 4 years ago, 5 years ago on a valuation basis, and we are almost doubled from then. Because 2020 valuation before the pandemic, it was the second, third most expensive market in history, and we are just up from there. But when it comes also to the cash and being invested, Warren Buffett is Warren Buffett. We can learn from him, but we can't really do what he does. So we have to check the value investing opportunities out there. Something very important to understand is that the number of listed companies out there is around 58,000, even likely more because this is from 2022. Let's say 60,000 listed companies globally, and that's a lot. Further, if we look at the share of the global market capitalization, the US has 64%, Europe has 11%, so 75% goes to developed markets, emerging markets is just 10%. And let me show you something else. 75% of the money is in the most expensive market out there, the United States, Europe, Japan, and just 10% is in emerging markets. Those have half the valuations of the developed markets. Further, this is the world's population. Now, I think it is something I don't have to mention, but it's good to keep in mind. 64% of the market is North America, and where do we have Europe from a population perspective? This. So this is 75% of the market. This is 10% of the market. This huge chunk of the globe. And that also means that you might want to look for opportunities globally. But then again, how much exposure to emerging markets, how much knowledge? I always say it is a process. You do something for a few years and we'll touch that on point number 4 in a second. But it is a process. You learn and then you see how you build that portfolio over time. Because in this comment, the market had some temporary moment of insanity. Temporary, can there be other temporary moments of insanity across the globe? Perhaps the cheapness of Asia will be looked upon as a longer moment of insanity by the market 5-10 years down the road. There are certainly risks, that's a given, but that's why it is cheap. And then you build a portfolio around it. But the key question, the framework I use when it comes to the question keep money in cash and why I am 100% invested is the following. I have this framework. When I invest, I expect returns of around 15% per year. Over my 22 years of investing, that has been done, so I'm very happy with it, and I try to find value investments that offer me that. And if you look at my research platform, I follow companies across the globe, and then from these companies I select those companies for a portfolio that I think can give me good returns over time. And now I have 4 strong and 9 good buys for my portfolios. So I have my money invested in some things that I think will give me 15%. Perhaps you say I'm happy with 10% and then you have a lot of less things to think. Because when it gets to 10%, if the stock goes up, I still hold it, and only then, when it gets exuberant, I might sell. Or if there is an opportunity to buy better, then I buy that, depending on where I feel. But as I do a lot of research and look at markets and follow things, there is always these moments, temporary or not, of insanity that offer opportunities. And that's why I want to discuss the moment in time perspective versus a dynamic overview. Because the moment in time, maybe you don't have cash now, but Warren Buffett bought Coca-Cola in 1989, the yield was 2.5%, now it is 2.6%, but the dividend went from 3 cents to $1.91. So Warren Buffett spent here $1.3 billion to buy the stake. He is now getting $750 million per year from that investment. And that's the moment in time thing, because each year he can reinvest those dividends into the opportunities out there, and then he builds a portfolio with that. We can say that Apple is also partly this huge position now because he reinvested Coca-Cola's dividends. The stock didn't do great over the last 20 years, but the dividend just kept on compounding, and that's his ownership stake, as I said, $750 million per year. And in addition, being invested versus not, most of us get a salary, get some money each month and reinvest. That's what I do with 2 of my portfolios. Constantly, monthly, we add, we buy the best opportunities, and over the long term, reinvest the dividends. Something gets exuberant, something you sell, you manage. Maybe you will not have cash to buy now an opportunity, but down the road, 5-6 months, you structure a little bit and then buy slowly and steadily. Because the goal is not to win big in the next 6 months. The goal is to compound steadily. And just reinvesting a dividend with the right mindset, let's say that over 20-30 years you do 13%, not 10. That's $1 million if you started with 5,000 and adding a little bit every month. So that's double the portfolio, just from a small difference here and there. Compared to what usually the average investor does, is doing the wrong thing at the wrong moment in time, selling, predicting, etc., not thinking about long-term compounding, and therefore the average investor return is lower than the market and also than our return over the last 7 years or over the last 20-something years. So value investing is the process of building a portfolio on business ownership over time, just like a puzzle. What fits, what is the return, what is the risk and reward. And on answering the question how much cash to hold, if there is something that's offering 10%, I'm happy with zero cash. If it goes lower, dividends, monthly additions to portfolio, you manage your life and your financials. If there is nothing, you think of quality of life, you buy your boat that you always dreamed, things like that. At the end, the money is there for you. And actually, there is always something overlooked. The world is big, and I think you agree with me that the average person is, how do you call it, insane when it comes to finances. So markets will always be irrational, like it was for this company. The S&P 500 peaked March 2000. A company called Berkshire bottomed in March 2000. And the rest is history. Thanks for watching. I hope I helped you a little bit. If I did, smash that like button. I'll see you in the next video.